The International Monetary Fund says a third of world economies will slip into recession this year, but the worst hit will be in the developing world. The IMF's chief says the impact of the war in Ukraine is just one factor that's hit growth prospects for the world's poorest countries. It says more than a third of countries in the Middle East and North Africa are particularly exposed to the ongoing effects of the COVID pandemic and higher food and energy costs. Well, let's talk now to Bill Blain, who's a market strategist and head of alternative assets at the investment firm Shard Capital. Good to have you with us, Bill. So how is high inflation particularly affecting emerging and developing economies? We're seeing it worldwide, but how is it affecting those?
Well, it's been absolutely fascinating the last couple of months since this inflation trigger started to move global economies. We've already seen a number of the more struggling economies in the developing world start to really suffer the consequences of food inflation and energy inflation. Now, that is going to be exacerbated as we continue to see interest rates rise. We had the Fed yesterday increasing only by 25 basis points, but then the Bank of England move today kind of hints that despite the market wanting rates to start falling, it isn't going to happen anywhere soon. Now, it just so happens I've just got back from a business trip from Egypt, which is why my home office is so scruffy today. I do apologise. But Egypt's a good example where they've been forced to devalue, but they're doing everything they can to improve the basis of the economy, to attract in foreign investment. And once that starts to happen, you'll see more confidence in economies like Egypt. Where economies don't make changes, that's when they're really going to start to struggle.
So you picked out Egypt there, but which other countries are being hit hardest?
Well, we've already seen the crisis most visibly in Sri Lanka, but across the globe, you've got a whole number of economies that will be struggling today with higher energy costs, higher food costs, and although many of them will be commodity-based economies where they're exporting raw materials, for instance, they're going to be struggling, and that's happening in Latin America, it's happening in Africa, it's even happening in some of the developing and emerging nations in Asia. This is a developing story.
So we've seen rate rises more or less across the board in Europe, the UK, the US, trying to tackle this soaring inflation. But those rate rises are also hurting developing countries who borrowed money when rates were lower. Is that one of the main problems?
Well, one of the classic debt traps is for emerging nations to borrow in foreign currencies, typically in dollars, euros, or sterling, and then they start to suffer a adverse currency market where their currency weakens. As a result, when it comes time to repay that debt, they find themselves paying relatively far more. Now, that's often been a trap. At the moment, we're still seeing US rates rising, and that's one of the reasons that dollar strength has been such a problem for many emerging market economies. If the dollar's strong, they struggle more. Now, that will start to ease because we are seeing, we have expectations that the dollar will start to weaken later this year once we see the pace of interest rates really stop. And that's likely to be sooner rather than later. That will give some respite to many nations that are heavily dollar indebted. But debt is a global crisis. Many nations are over indebted, and if a nation's over-levered, it doesn't help confidence that that economy is going to be able to steer itself into a more sustainable place. And that, I'm afraid, is going to remain the story this year, especially if the IMF is right about rising recession. But to be positive, there are very good signs that the recession is going to be less damaging than was originally predicted. Even the IMF, surprisingly, has scaled back the amount of pain it was expecting.
OK, Bill Blain, good to talk to you. Thank you for joining us today. That's Bill Blain from Shard Capital.